Hi, welcome back to day 119 of our 365-day investment challenge. Today we are diving deep into the world of mutual funds. We will see how to analyze their performance. We will also cover the critical role of comparing them to their peers. Let's understand mutual fund performance. Imagine you're shopping for a new phone. You wouldn't pick the first one you see, right? You would compare the specifics, features, and most importantly, the price. Also, analyzing a mutual fund performance is about more than its return. Let's explore some key matrices with example. The first one is total return. Total return is the sum of two things. It is the fund's share price increase and any dividend paid out. It tells you the growth of your investment. For example, if you have invested rupees 10,000 in mutual fund and after 1 year the value is increased by 10%, you have received 500 as dividend, your total return will be 10% of 10,000 which is 1,000 plus 500 which is 1,500. Second parameter is CAGR. CAGR smooths annual returns and gives you a clearer picture of the fund's long-term performance. Let's say a mutual fund delivered a return of 12%, 8%, and 15% over the past 3 years. The CAGR would be about 11.4%. This shows more steadily trend than just looking at the last annual returns. The third parameter is standard deviation. It measures volatility. It shows how much the fund's returns fluctuate. A higher standard deviation indicates a riskier fund. For example, a mutual fund with a standard deviation of 20% might have returns that swing significantly between 20% and plus 20% and minus 20% in a year. This is compared to a fund with a standard deviation of 10%, which might have a tighter range of returns around its average. Fourth is the Sharpe ratio. It compares the fund's return to its risk free rate. The risk free rate is what you get on the government bond, and the adjustment accounts for its volatility. A higher Sharpe ratio indicates better returns. It adjusts for risk. Imagine there are two funds, Fund A and Fund B. Fund A returns 15% but with a risk of 25%, whereas Fund B returns 12% but with a risk of 18%. Fund A has a higher headline return, but Fund B's Sharpe ratio might be higher. This is because it has got a good return with less volatility. Looking at these matrices alone doesn't tell the whole story. That's why peer comparison comes in. This means comparing the fund's performance to the other funds. They have similar investment objectives and strategies. Comparing to the peers is common. It happens in performance evaluation. So it helps investors see how their fund is doing relative to others in the same category. Now, why is it so crucial? First one, benchmarking. Every mutual fund has a category. It is based on the type of companies it invests in, such as large cap, mid cap, or sectoral. Comparing the fund's performance to its category average tells you whether it is beating the market. It also tells you this the average is the benchmark. This is a crucial first step. But it is not enough. By only looking at the benchmark, you might miss a hidden gem. You can spot trends by comparing a fund's performance with its peers. They are in the common category or in the same category. Do this over different time frames, maybe 1 year, 3 year, 5 years. Let's say you're looking at two funds within the large cap category. Okay, so Fund A might have beaten the benchmark last year, but how does it compare to its peers? Fund B has beaten both the benchmark and its peers over 5 years. It has a similar risk, so it might be a better choice for your portfolio. Second, understanding risk adjusted performance. Peer comparison also helps you see a fund's risk. It takes that risk to achieve its returns. Comparing the Sharpe ratio of funds in the same category shows you which one deliver better returns. They do so relative to their level of volatility. So comparing to peers help you see a mutual fund's performance. It makes it clearer. It helps you gauge the effectiveness in its market. You can use it to find consistent performers. This will help you make better decisions about investment. Now let's see how to compare mutual funds. Many websites and apps offer tools. You can use them to compare mutual funds. You can use these tools to input criteria. For example, fund category and expense ratio. You can pick on the investment style, value, growth, or blend. Then you can compare funds side by side. You can do this based on chosen matrices and historical data. This can be a great starting point for your research. Don't chase the highest return. Consider your risk tolerance and investment goals. Keep them in mind when picking a fund. For example, you might focus on keeping capital safe. You might do this instead. It's better if you are nearing retirement. Look for funds with a consistent track record. They deliver returns that match your goals. Also consider the level of risk. Remember, studying fund performance is important. It is the key for investors. They must compare it to the peers before investing. Spend time researching. Understand how the fund has performed. Compare it to its category and similar funds. Thank you for joining us today. We hope this session empowered you. It will help you analyze mutual fund performance. You will do so with confidence. Stay tuned for tomorrow's challenge. We will dwell deeper into investing. So, see you tomorrow. Bye bye.